Let's explore this tax question. It asks us to determine the overall tax rate on Show's income in the first year if Show is organized as an LLC or as a C corporation. Okay, so you see the information on the screen. Andrea would like to organize Show as either an LLC, which would be taxed as a sole proprietorship, or a C corporation. In either form, the entity is expected to generate a 7% annual before-tax return on a $230,000 investment. Andrea's marginal income tax rate is 35% and her tax rate on dividends and capital gains is 15%. She'll also pay 3.8% net investment income tax on dividends and capital gains she recognizes. Now, if Andrea organizes Show as an LLC, Andrea will be required to pay an additional 2.9% for self-employment tax and additional 0.9% for the additional Medicare tax. And she's eligible to claim the full deduction for qualified business income. Assume that Show will pay out all of its after-tax earnings every year as a dividend if it is formed as a C corporation. Okay, now, they tell us round our intermediate computations to the nearest whole dollar amount. All right, so let's start off and let's see how we would approach this one. So first, we know that the investment is $230,000, and the pre-tax earnings that's expected would be 7%. So 7% of $230,000. We start off with pre-tax earnings of $16,100 for an LLC and a C Corp. Now, the next set of calculations deal with the entity level tax rate, which is 21%, which would take effect for a C corporation. Of course, there wouldn't be one for an LLC. So if we take the $16,100 pre-tax earnings times the 21%, we're going to come up with $3,381. And now we see that earnings after the entity tax level drops to $12,719 for the C Corp. And of course, there is none for the LLC, so we're still at $16,100. All right, so what do we have next? Okay, so next we have the qualified business income deduction. It's 20%. And this applies to the LLC, but not the C Corp. Now, here's just a refresher on that. I found this image at the IRS webpage. Well, actually, I found this at the IRS website. I just took a screen image of it. Okay, and what does it tell us? It says for taxable years beginning after December 31st, taxpayers other than corporations may be entitled to a deduction for up to 20% of their qualified business income. There's our QBI. From a qualified trade or business. Okay? This deduction can be taken in addition to standardized items deductions. And this applies to taxpayers other than corporations. All right, so that explains where that 20% comes from and why it doesn't apply to the C Corp, but it does to the LLC. All right, the next thing we have to think through is the 50% deduction of the self-employment tax. Now, okay, so if you look at this calculation, which applies to the LLC, we take the pre-tax earnings and we multiply it times 92.35% of the taxpayer's self-employment income. Okay, that's the net amount that a taxpayer gets, right? They get the deduction of the 1 minus the 92.35%, which is 7.65%. Okay, and then we have to multiply that times the 2.9%, which is the additional self-employment tax, but we get to multiply that times 50%. Now, where's the 50% come in? Taxpayers are allowed to deduct 50% of the self-employment tax they pay as part of their AGI, adjustable gross income deduction. Okay, so if we take items 4, 5, and 6, which is the earnings after entity level tax, and then we essentially subtract out the QBI deduction and the deduction of the 50% of the self-employment tax, we wind up with $12,664 for the LLC. Of course, we only have the $12,719 of the earnings after the entity level tax on the corporate side for the C Corp, and we assume that it's all distributed as a dividend. All right, so the next thing we need to consider is the income tax paid by the owner. Okay, now they tell us that Andrea's marginal income tax rate is 35%. So we've got 35% of that income will show up as an LLC. On the C Corp side, they tell us that capital gains, which would apply to the income that's distributed as a dividend, is 15%. So we come up with 1908. Here we get 4432. All right, then we have to consider the self-employment tax. So we take the 9235 times the 2.9%. And then there's the additional Medicare tax and the net investment income. All right, that's $134. So now we're taking that same 92.35% times the 0.009. That's the additional 0.9% for the additional Medicare tax. All right, so we need to consider that. On the corporate side, we need to consider that there's the net investment income tax. And they tell us that Andrew will also pay 3.8% net investment income tax on dividends and capital gains. All right, so when we consider all of those, we can add items 8, 9, and 10. You know, our subtotals as we're going here. We've got 8, 9, and 10, and we can determine what the after-tax flow is by taking the pre-tax income and then subtracting all of the taxes involved for the LLC versus the C Corp. And when we do that, we see the after-tax cash flow is $11,103 for the LLC, a little bit better than the C Corp of $10,328. So the final question is to calculate the overall tax rate. So now we simply take the after-tax cash flow and divide it by pre-tax earnings. We do that on both sides, right? So after-tax cash flow, $11,103, divided by say that again. We're going to divide that by the pre-tax earnings. Actually, we're going to take the owner level tax, not the after-tax cash flow. The owner level tax divided by the pre-tax, and then take the total corporate tax and divide it by the pre-tax. Actually, to do an apples-to-apples comparison, that's not true on the corporate side. What you want to do is you want to take the earnings after the entity level tax, or let me say that again. You want to take the entity level tax and whatever the owner level tax would be reflected from a C corporation. So we're going to take items 3, the 3381, and items 11, the 2391, and then divide it by pre-tax earnings. In other words, you want to compare the total tax to pre-tax earnings, compare the LLC to the C Corp. And when we do that, we're able to solve this one in its entirety. Let me get that out of the way for you. Okay, and there you see how we tackle this one. Thank you.